Hi everyone, thank you for taking the time to listen to us this afternoon. Given we've already been introduced, I'll save time from repeating ourselves. I think we've actually given quite a bit of thought to organising the panel, as we seem to have investors representing each stage. So I thought one interesting area to start would perhaps be giving the audience a bit more detail on the stage of which you invest, and then diving into more detail about what you look for at that stage. And Reshma, why don't we kick off with you?
Perfect. So we're very much pre-seed and seed, so we often co-invest at the pre-seed stage, either by ourselves or co-invest with angels to a large extent. And at the seed stage, we tend to co-invest with some of the seed stage VCs. We see you guys, right? And often LocalGlobe and others as well. So we're very concentrated on that pre-series A. We write checks of 100 to 400K in rounds of up to 2 million. We're focused across Europe and very multi-sector, kind of half B2B, half B2C. And I think when you're doing your homework, it's good to know just the stats that I just mentioned, because then you can really target who you want to speak with, and when you look to talk to venture investors. And the last bit is, I think, highly correlated with our success in terms of the companies we've backed is probably when one of these three folks is on the cap table after us. So we work hard on behalf of our companies alongside them to ensure, after us in the Series A, B, C onwards, we get the best of the best VCs across Europe, US, Asia, and so forth.
You go ahead. I'll come after her.
Sure. Great to be here, thank you. At Index, we invest, we call it multi-stage. We invest out of two funds. One is a Index Ventures fund, one is a growth fund. The boundary between two is blurred, and specifically, growth is defined differently by different people. Historically, it used to mean firms like General Atlantic investing 50, 100 million per deal. Now we see the definition of growth being companies that sort of have some revenue and business, and that's typically starting at Series B. Through the venture fund, we selectively invest in seed and often work with the fellow co-investors here on the panel, and primarily then focus on Series A, sometimes Series B, and that's where the two funds overlap. Series Bs have gotten slightly bigger. In fact, all the rounds have gotten bigger, and that's where the alphabet becomes a little bit redundant, because what used to be the Cs are now the As, and amounts are getting bigger. So I'm sure we'll come onto it.
Yeah, so we're a bit different because we're not a fund, we're a public company with a balance sheet, so we invest in any company at any stage. In terms of seed funds, we don't do seed investing directly, but we've got 19 seed funds now where we've become an LP, and we invested in about, an average, about 30, 40,000 in 150 companies last year through that network, which is great. We did about 30 deals last year, half Series A, half Series B, C. But we don't actually just invest when you're raising money. We do an awful lot of secondary investing as well. So we actually just think like a normal investor. The idea that you have a fund and a particular strategy is a remnant of the limited partnership model, which has come from California 50, 60 years ago from Tim Draper's grandfather. And actually in the public markets, people like Warren Buffett invest in the best companies at any stage for the long term. So we're trying to apply a little bit more of that long-term methodology to venture investing in private companies.
So you've all referenced stage, seed, A, B. For these founders who are probably left scratching their heads somewhat, which is the question that they always ask, am I ready to raise this next round, or am I even ready to raise a round? And I think let's help distill it down a bit. And Reshma, again, we're going to start with you being in the earlier stage. But before we used to talk about seed, and now we talk about pre-seed, seed, late seed, early A.
Yeah.
What is it that you're looking for at this stage?
I mean, so for pre-seed, it's very much, we invest in anything from literally a couple of slides, idea, to some of the companies that come to pre-seed because they don't maybe necessarily have a network, or they're pivoting, will have a bit of revenue, right? So it's from pre-product all the way to revenue at pre-seed, and that is just that kind of 100K check from us, maybe a couple of 100K from some of our LPs or other angels you've lined up for sort of a 500K max round, but usually around 300, 400K, to really just start to get out there, start to build product, start to have a little bit of a core team that you start to pull together. It's very much a hope and a prayer that you'll actually even build anything. And then seed is, so we really won't do seed rounds between $500,000 and $1 million. We found it historically kind of a death zone. It's tough to raise a larger seed round off of that. And then in seed, we participate therefore in 1 to 2 million rounds. And they're often becoming definitely much more 1.5 to 2 million size rounds. There you have more of a team, you definitely have a product, and you have early stage, if on the B2B side, kind of SaaS side, early stages of revenue. So you're starting to see product market fit, traction, and you can talk about it as well. You can articulate around that. And you're raising, a couple of million to start to get an engine going, so that when we help them prepare to pitch to these guys, you have a repeatable model, and you can really talk about how to put in, get 5 million, 5-6 million from these folks into that Series A to really kind of get that revenue engine, growth engine going.
And then Jan and Simon, perhaps you can talk about how you differentiate between an A and a B, and what are the metrics or what are the things you're looking for before you guys come in?
Well, actually, I think the truth is we give money to entrepreneurs for them to scale their businesses, and the best entrepreneurs will do that the least amount of times possible. So if you think, I think the whole ABC thing is just invented as language for our industry to make this a little bit more complicated than it is. If you've got a great company right now, you own 100% of it. If you can grow that without any dilution, you should do that. If you have an opportunity or you need some capital to develop that product, then you should take on and raise some money, and you should do that the least number of times. And if you do that 8 times, you'll have an 8-round series by Alphabet, right? So, but you really shouldn't raise money unless you can see the trade-off. A round is always, 10, 20, 30%. It's never 60, 70%, because that's private equity. We're here to be minority investors, but, so you should really, if you want to raise some money, it's really a question of has your business got enough evidence to show that you can raise an amount of money. If you're a first-time entrepreneur and there's not a lot of evidence that what you're doing has much chance of success, the amount of money you can raise will probably be quite small, and then therefore you'll fall into a lower valuation. If you're somebody like Alex Chesterman, who's done great things, he can go out and raise whatever 30, 40 million pounds in his first round, right? So people call that a 40 million pound seed round, but the truth is, it's really raise the least amount of money you possibly can, the least number of times, and forget about the alphabet, from my point of view.
Yeah, this is the most non-controversial panel I think I've been on. I think we all agree with each other. To simplify, this alphabet soup really does not make sense in today's world. I think, Simon, you're right, that the amounts really relate more to milestones and where you are, what you need. And again, to simplify it for the audience, I think typically we would start looking at a very early business, when Reshma calls, when the company is looking to raise 1-2 million at the low end. Typically the Series A's we see start at 5 million all the way to 10 and sometimes 15, depending on capital needs. And I think pretty clearly at that Series A, we're looking for product market fit. So again, to simplify, it would be companies that have launched, most typically, and where there are early customers showing love of the product or the service.
And I think to underscore this point about kind of the irrelevancy of the letter, we had a portfolio company just recently raise its first round at Series A, a $200 million round at $2 billion. So I think it goes to show that investors are just naming it what they want at the moment. Okay, let's switch it up a bit and maybe talk about some of the themes and trends that are all exciting you. We'll kickstart from my left. Historically, you've spent a lot of time on financial services, data and information. Are those still sectors that you're spending time on and are excited by, or are you looking at other things these days?
Yeah, I would say we historically used to invest more in technology for a particular sector. I think now the bigger opportunity is to look at companies that aim to reorganize a particular sector. So rather than looking for software for banks, we've invested, as an example, with Reshma's fund in Revolut and neobank. So we invest in the bank itself. And the theme sort of follows, whether that's software for food delivery, would invest in food delivery, or transportation. So we're looking at big verticals. One of the examples would be Alan company that you could say is a fintech company. It's a technology business. It's a financial services business and insurance. It's also a healthcare business. And I would say the one thing underlying all these great startups is the level of ambition. So in the case of Alan, the aim is to reorganize the healthcare system that needs obviously a lot of work. And the healthcare insurance is just a wedge to get customers, get data, be better able to understand the underlying demographic. And we see this in a lot of other sectors, whether it's travel. We have an investment with Blossom in the travel space, or other spaces where you rework the full supply chain and turn things upside down through technology.
And Reshma, I mean, I guess you're seeing things really at the formative stage and probably spotting trends the earliest. And given you cross all of Europe, kind of, do you see the same trends emerging from every single country? How do you think about the applicability of what you see from France, Germany, et cetera, in your investment process?
Yeah, that's a good question. I mean, I do think, the sort of trend towards democratization of all kinds of ideas coming from everywhere marches on quite seriously. So I do think we see ideas coming from everywhere. That said, though, I mean, around sort of personalized health, it's definitely an area we're investing quite heavily in. I think where healthcare is dramatically broken, and places where there's an egregious spend on that, the US and UK particularly. Well, UK has NHS, but it's under threat, right? So I think you see, and it's such a powerful system. We definitely see much more kind of health and health related, and AI being, and we have an AI powerhouse here as well. So we see a lot of that. In Nordics, I mean, we see a lot of, we continue to see, beautifully designed products, a lot around sort of SaaS work, process management, workflow management. In France and Germany, we continue to see more ideas around, big trade organizations, and how do you, again, around supply chains and how that's changing, and how is trade management changing. So there's still some nuances around the areas where the countries have been traditionally powerful in, but still more and more, all kinds of ideas come from everywhere. And then there's sort of UiPath that's come out of Romania, right? And all around kind of, again, AI in the enterprise space. So I will say though, anything AI and machine learning in the back end is having a massive impact. And definitely in enterprises, as we see with UiPath, but around health. And I'll say added to that change, we're seeing how money is spent change dramatically. How people spend their wallet of money and time is changing dramatically. So we have a company called Ezra AI in New York, where people are paying out of their pocket to get full body MRI scans. They scan for 11 cancers in women, I think 10 cancers in men. Dramatic, right? We have a genetics company that's about to launch a personalized genome sequencing kit for $800, and no, insurance isn't paying for that. That's people paying out of their pocket, and you couldn't have thought of that sort of a few years ago. Thriva, which is doing incredibly well with personalized blood kits. We think about it as a blood gateway to your health. So people are spending quarterly out of pocket, kind of 50 quid, 100 quid, 500 quid. It's incredible. So clearly I could go on for too long.
And Simon, do you go thematically at Draper Esprit, or how do you kind of cut and divide the universe?
No, I think the great thing about being a venture capitalist is we don't have to do any thinking about entrepreneurial opportunities. We just have to be the go-to person for the best entrepreneurs, because that's the definition of an entrepreneur. They're spotting an opportunity before anybody else. And we're never going to be that smart. So, and that's, I think that the word Jan said is the most important thing we look for across Europe now, and it's really increasing, and it's that ambition. If there's a commonality of what we look for, we don't care what the business is, but it's It's the ambition to change the world and to go big. And you know, 5-10 years ago, you'd see a business plan in Europe, and they might aspire to $20 million revenue in year 5, right? And it was just the ambition wasn't there. And so there's so many opportunities. I think the one big overriding theme in Europe potentially is the role of regulation and technology is now coming together. You know, we've had unregulated free technology adoption in the States for 20, 30 years, and we've ended up in a bit of a mess. And you know, it'd be like putting autonomous cars on the road with no rules, right? There'd be death everywhere. And so I think the fintech revolution is here in Europe, and particularly in London, because of some of the Cameron Osborne government initiatives. The regulators are very open, and open banking and things. And across Europe, I think we have the advantage of a regulatory system that, if it works in partnership with entrepreneurs, we can build the next generation businesses the right way and global leaders, compared to the sort of, you know, the class action suit American model or the sort of autocratic state Asian model. I think there's a really interesting opportunity over the next 10, 20 years for Europe to come up with some models which can work really well.
I have to say I completely agree with you. I always tell founders that they should never expect their investors to be smarter in an industry that they're going after. But obviously you should be kind of having some kind of thesis on this space. Jan, if we go back to your investment in Alain, obviously this is a company that started in France and got its license and originally to operate in France. But you know, for Index to be excited, you're clearly thinking about the opportunity across Europe, if not into the US. So how do you encourage founders to think about international expansion and the opportunity outside of their home country before thinking about raising, you know, A, B, or whatever round that might be compelling to someone like Index?
That's a really good question. I would start with what you sort of implied, which is we're not there as investors and VCs to tell the founders what to do. We see ourselves as supportive coaches or sounding boards, and we look for that ambition and the big vision at the get-go. And I would say it's the best thing, if you don't see it, is to not invest rather than invest in your own ideal what the company might be, and then sort of be disappointed that the founders actually want to do something different. So I think rule number one, clear communication between the founders pitching and the investors listening, I think is really important, because then you don't stand to be disappointed that you're not investing in something else than you thought. So I would reiterate that ambition and sort of go big, go global. I think all of us here, the four of us, are looking for at the outset. There's clearly a number of industries and business models that lend themselves to cross-border adoption, anything to do with mobile app store distribution, software companies in the cloud, businesses that use data, and back to sort of the competencies. Simon, you mentioned sort of what Europe's produced in fintech. If you just step back and reflect how many extremely large companies have been built in the data space out of Europe, whether that's Reuters or Reed Elsevier or Experian or Market or others that we could name, and a lot of these are ultimately fintech businesses. You sort of step back and think there's a certain competence, and these businesses have been making it global for decades. And again, it goes back to what we look for, which is business models that lend themselves to adoption, and at the same time, founders that have that desire to go big.
And Reshma, presumably a lot of your companies are asking for help with thinking about expansion, probably to the US. You mentioned this portfolio company in New York. How do you think about getting over to the US, and when's the right time to start thinking about having an office there or an outpost there?
Yeah, I mean, I think the timing's probably the hardest question. I think it's, I don't know if anybody really gets it right, you know, exactly. There is always that debate on, you know, do you really secure your home market and think internationally after, or do you do it kind of simultaneously? I mean, again, we've probably got it wrong as many times as we've gotten it right, so I think we're not advising as much on that. But I think what we do try to advise on is, you know, when you're going to do it, be serious about it. Every time a company of ours has just sort of gone over, especially to the US, I think just to flirt, it's never worked out. You know, you need a marriage, you need a commitment. So you need to get out there. You need to be founders who go out there, at least one, if not more. And you need a really strong set of local network, whether that's founder network, investor network. It's crucial in sort of which city you decide to go into, how you recruit, what kind of talent actually comes to you, because there's a bit of a joke in the industry about European companies coming over and you get like tier 2, tier 3 talent applying for your roles, and how do you really get to that tier 1 talent, and again, navigating through the right networks, the right relationships to work through to get to those kinds of people. So that's a lot of where our advice is spent on. Timing's fair bit harder, and to be fair, I guess on ourselves a little bit is, from seed to Series A, we absolutely work hard to bring folks like you guys on board, and so usually Series A onwards is more of that conversation around international, and we're certainly hoping, I think, looking over this way to get some really good input.
Simon, you mentioned earlier that JPOSB is there for secondaries as well, and it feels like in Europe, that's long been a taboo topic for founders to take money off the table at the early stage, kind of an indication that they're willing to sell out and not really build this for the long haul. Yeah. Can you talk a bit more about how you're seeing that market and the approach that you take?
Well, I think it's the nature of the bar to go public is so high. Companies are staying private, for longer and longer and longer, and they outlive the life of the 10-year fund. 5 years to invest, 5 years to exit. But I think there's just a realization that a company has value at any particular point in time. You don't want the founder completely disincentivized. I run a public company. I'm locked up in my shares for 5 years. So even in public companies, there are rules and what the founders can do. But I think there's absolute. It's correct. There should be liquidity. Everybody has a different agenda. There's different things going on. Companies have value. You shouldn't force employees not to be able to exit or leave. A company like Trustpilot we've built up under Danish law, every time there's a stock option grant, they have to pay a tax bill. So, why not help them by buying some shares from the employees so they can? I think you have to have a much more open-minded, flexible approach. Just realize these are real companies with real people, and just because they're private doesn't mean you shouldn't be some solutions to liquidity. And the demand is building. What you see at the other end is, all of the people looking for growth. The public market investors were getting 30-40% growth from Google and Amazon for the last decade. That's come off now, and so they're looking everywhere for 30, 40, 50% growth, and they're coming down into the companies that are being built in places like this, and so there's a huge amount of demand coming down, and why not feed that through to all the way down? It doesn't stop at a certain point. There's more demand once you're over £1 billion valuation. But there's no reason why that can't come all the way down, I think.
And I think, not only for startups, for funds as well.
Exactly.
So as we sold our first 2 funds to Draper, same thing is the nature of LPs putting money into us. I mean, we kind of rewrote the book on that. And so we got a bunch of angel investors actually to put money into our fund, and VCs themselves, different kinds of institutions. And only more recently have we gone to endowments and kind of the more traditional LP model. So the nature of changing who our LPs are meant their interest around liquidity changed dramatically as well. So the angels constantly want to recycle much faster than EIF or Harvard Endowment probably wants to, right? VCs like you guys being in, you have different interests as well. So I think it's fantastic to have different models around all this and to have that secondary option be available for startups and funds.
And again, a lot of it's interesting because crowdfunding is still illegal in America. So again, crowdfunding, Crowdcube and Seeders, which we're invested in both, are doing really well here. All across Europe, there's secondary market activity. Again, we're a listed venture fund. You couldn't do that in America. It's illegal. So Europe has a real advantage to solve some of these particular liquidity issues. And who knows, maybe the model that comes out here over the next 10, 20 years will be the one, because I don't think the limited partnership model is going to last forever. It works in America for now. At some point, it may be replaced by a different model.
And I mean, you spoke about companies staying private for longer. We're seeing so much growth capital enter this market. Jan, given where we are at this stage in the cycle, how do you feel as a growth investor about how competitive this market is as you get to later rounds?
There's definitely been more and more capital inflows into our asset class. There's no denying, and it's a balance where, at the end of the day, the intelligent use of that capital is really finding those great, exceptional startups that will create the return. And sort of the birth rate of startups has been increasing, thankfully. I think all of us have been beneficiaries, and sort of the market is finding its own equilibrium. But it is also true that the skew of the amount of capital is primarily at the very large end. And one could argue that the IPO markets have been sort of de-substituted, and that's where the very late stage capital has really provided an alternative to IPO exits. That it has caused some distortions, but ultimately that market has to find its own return because the end holders of that capital are looking for a certain return.
We've only got a couple of minutes left, so why don't we take it in turn? One piece of advice for these founders in the audience raising capital today, what would it be? And Simon, why don't we start with you?
Well, I'll just sort of echo the theme I said earlier, but if you're going to build a business, don't build it for venture capitalists and think about some weird language like Series A, B, C. Build the company for you, build it for your customers, build it for your mother. If it's any good, we'll come and find you, and we'll be knocking on the door trying to give you money to help it grow. So, I think the best thing you can ever do as a startup, is focus on what it is you're doing for your customers, make sure your employees are happy, and there's 10 million SMEs in Europe, there's 10 million in the States, there's 1,000 or 2,000 venture deals a year. 99.99% of businesses are wonderful things, and they don't need venture capital.
But if venture capital is...
we have money for you.
Yeah, right? But obviously, VC money is fuel. It's fuel for growth. So I think, if you're going to take that money, wanting to take that money, I think do your research, understand why is that? Is that controversial?
I was going to say that.
Oh. Because it's probably one of the things that differentiates, hopefully, what we do at Seedcamp, versus founders kind of just going out to pitch, is we really constantly kind of badger that point home, which I'll let you have the last word on.
Well, thank you for investing in all those great companies at seed stage. I would echo what Reshma said. Do your homework, do your preparation. It is really the time for entrepreneurs. It's probably never been better times in terms of availability of resources and accelerators and events and tools and friendly mentors. So really all the cards are in your hands, so you have the choice, but use it wisely. If you have access to capital and it's an enabler, take that capital, but also there's the quid pro quo in the sense that to raise the next round, you have to show the return and what you've created with that capital.
I think I would echo that. Don't forget that ultimately, actually, you are the customer. So when you're thinking about raising your financing, you can do your homework on making sure that you're finding the right partner, that they are active in your sector, in your industry, they're right for the stage that you're at. And hopefully, if you do choose to raise money, you're finding a great partner in that process. Well, I think that's time up. Thank you, everyone, and thank you.
Thank you.